this now. Let's try to do this. Okay. So thanks a lot for your patience. I'm Giuseppe Basile, and I want to welcome you. Thanks for joining in today on behalf of FXStreet as well as FibStalker Trade, which is my own company. Today I'm going to talk about modeling modern algorithms. I'm going to share a couple of models you can use, very easy to use, and they're very, very effective. And then I'm going to talk about a way to automate execution, which is very, very important. It gives us an edge, and we want to be able to get any edge we can when it comes to trading. So let me start right away because we lost a little bit of time. So of course, risk management is trader's job number one. I heard a question before, and someone was asking, why do people after 10 years of trading activity, they are not successful? Very simple question. They don't manage risk. Case closed. That's it. They do not manage risk properly. That's it. And I'm going to share. So for those of you who are watching the recording, please read this slide. I won't have time to go through it, but that's the common disclaimer that you'll see everywhere. Just a little bit about myself. I'm a computer science engineer, and in 2010, I also took a master's in finance. I'm a certified market technician, and by the way, there's a little mistake on my badge. I'm not a chartered market technician, but a certified market technician. And actually, if you go on the website, it was corrected. So you find myself among the chartered technicians, you won't find me, so I'm telling you. So I started in 2000, committed to research in 2003. Only in 2006, unfortunately, I understood the importance of mentoring in trading. I thought I could solve the markets myself. However, but since 2009, I actually collected 19,000 hours. I had some great mentors. Ivica Juracic in Europe, David Asley, Joe Di Napoli. And in 2012, I launched FibStalker Trading. I have a coaching program. I also teach an intraday trading system, and I started a Forex trading room where I trade live. I have a blog. And for FXStreet, I run a trading room. It's free, Sunday to Thursday, every day, 8 p.m. EST to 9 p.m. If you want to come and look at how I trade, you're free to do that. It's free. Just be my guest. So I'm also aligned to the International Federation of Tech Analysis. I wrote and published 3 research papers. I won't have time to go through this, but you can download this work. I will only spend a couple of words on this. The relation between money management and investing and trading results is very, very well documented and very well known. What is not known is that there is a relation between money management and trading goals, which I analyze in this paper. And if you're interested, you can download it on my blog. I also analyze the effect of high-frequency trading in the markets. I don't do, when I speak about algorithms, it's not high-frequency trading, it's classes of algorithms that trade on all time frames. So weekly, daily, 4 hour, 15 minutes, 1 minute, and even tick chart in some high-volume markets. Okay, so I won't spend a lot of time. These are some of the collaboration I have. All right, FXStreet. I don't know how many of you know about FXStreet. Have you ever heard about it? Very good. This is the largest portal in the world dedicated to retail trading. If there is one word that I would use to characterize this service is unbiased, right? Because we always listen a lot of analysis that might be biased, I don't know, right? The good idea is that if you come here, you'll get a lot of pieces of news, 650 pieces of news every day, every single day, all unbiased, a lot of contributors. There are a lot of webinars. There's a big commitment in teaching, trading in the right way. If you are interested in taking care of your own money and future as well. There is also, as I mentioned, a big commitment on education. I'm one of the contributors right there, bottom left, and I run the Tokyo Open live room every day, as I mentioned before. If you wanna come, join us to see how we trade. Now, the agenda of the meeting. I'm going to talk very briefly about my belief about price and algorithms in modern markets. I'll show you that current markets are completely different from what you did on the books. New uses of Fibonacci to model price in high-volume market. How algorithms have internalized the psychology of value. This is a very extremely fascinating area. I won't have a lot of time to spend on it, but I'll give you some pointers on FXStreet, and you can look at that. There are some open webinars. Everybody can look at that. They are free. How algorithms, smart money, and the plunge protection team has come into play. I will review some charts, SP500, some calls that I did in the last years and so, and also a recent trade that we also taken and we have commented on that room. And then I'll talk about automation. So we want to take advantage of any edge we have in the market if we are serious at trading, okay? And one of these is automation. I'm going to tell you about a project I started. I'll do a little demo on that, and then future develop. So this is interesting. Now, it's all about belief. Trading, it's all about belief. And I want to try to challenge your beliefs in the next 30 minutes. Before I do that, I want to remind you that Van Tarp said, we do not trade the markets. Very, very true. We trade our beliefs about the markets, right? So very, very important. So where do our beliefs come from? Well, they come from a number of sources: books, magazines, websites, brokers, direct experience, these kind of conferences, courses, right? That's the way we build our beliefs about how market behaves, and how we should be trading the markets. Now, modern markets are totally different from what you imagine. Here are some supporting facts, and actually this is data, which is stale data. It's old data, but it's still very, very valid to show the picture. An estimate of over 80% of volume in futures in 2009. Imagine 2016. Forex market projected to 50% in 2016. Options 20% in 2010, much higher now. IFTA, let's not even talk about it. Proof of existence of algorithms in price, is in price, and I'm going to show you in a minute. And here are the sources if you want to double check this, all right? So, my beliefs about modern markets, algorithms are here. Price is significantly and regularly affected by algorithms. An effective trading edge, as I'm going to show to you, can be derived based on modeling the algorithms. Some classes of algorithms, because in the market there are thousands, I would say hundreds and hundreds of different types of algorithms. We will pinpoint on one specific class, and algorithms are present on all time frames on high volume markets. Not on all markets, on high volume markets we can find algorithms or some classes of algorithms on all the time frames, down to the 1 minute, and in futures down to the tick charts. Simple price models that leverage Fibonacci can be used to project our area of participation of these algorithms. And as I mentioned before, they have internalized the psychology of the value. Very fascinating. Price behavior can be modeled to obtain an effective timing mechanism, which I call the FibStalking timing, and I'm going to show you an example of that. Now, I don't have time to do a full analysis and critique of the Fibonacci numbers, but I want to speak about what I call the uninvited guess. You all know the sequence of Fibonacci. Right? I don't have to explain that. So if you sum two numbers, you get a number. And now what is interesting is that what happens when we calculate ratios between these numbers. So a number in possession x divided by a number in possession x plus 1 gives us a notable ratio, 61.8%. As this number go up, the positions goes up. Everything tends to that 0.61.8. The reversal is the famous golden ratio, of course. And then you have some elaboration, I would say engineering in the Fibonacci number. And you should really ask, but wait a moment, why these numbers are important? Why if I get a number in position x and I divide for the number in position x plus 2, I get something which should be relevant for trading. Some people say that Fibonacci model our psychology, and that's the reason why we get that those bounces. They also model nature, and we saw these spirals and shapes in nature. But who say that that really models something fundamental about the market? In fact, I don't believe that. I believe there is a lot of engineering, like the square root of a ratio. What's the meaning of that? Who say that a tree is capable of calculating a square root? I don't know. If you know it and you have a proof, just show it to me. We have the 50% level, which is not even a Fibonacci number. So there's a lot of engineering there, so we have to keep only some of the numbers, and these are the numbers that I keep. Right, so I scratch everything. I think there is a better explanation for 23.6 and 38.2. I scratch the 68.6%, which has two different calculations. So based on what, right? So why those numbers should explain something fundamental about the market? I don't know. I scratch the 127 and keep David Asley 123.6, great number for targets, and then I keep the extension, the Dynamic extension there, and throw away all the rest. So here are the sources. Now, let me show you a simple model you can use again, again, and again. This is a simple 50% retrace. When the market moves from A to B, usually it retraces in C, the 50%, and most importantly, does not break below the 61.8% level, the red line there. And then you have two targets that are minus 23.6% and minus 61.8%. The first one is just the 23.6% of the distance between A to B above B, and the second one is the 61.8% distance of A to B above B. All right, so some examples very quickly. You know, we have plenty of them. We have X to Y, participation in W, first and second target hit, again C to D, participation in E, the market continued higher. On the larger time frame, A to B gives us C, and the market gets higher. Of course, should we buy this level blindly? Never, never, ever. We always want confirmation, okay? And I'm gonna show you how we get confirmation. Other example on the short side, A, B, participation in C, price getting very close. This is the euro-dollar daily. And there are plenty of examples. Of course, can you see that I always look and use very high volume markets. All these considerations only hold for high volume markets, okay? So let's look at another simple way. Now, what happens if the market respects the C level, then moves into D, and then eventually into E? So it reaches the second target, so the market is extended. And now we have to use same four levels that you see there, but we trace those Fibonacci levels and study in a different way. Indeed, what happens is that when the market is extended, it tends to retrace a little bit less. So the way we model that, we don't trace from F to H, but we trace from highs to highs in that case. If it was a short, we would trace from lows to lows. All right, and as you can see, the 50% in I comes at a slightly higher level, and some people will say, oh, but that's a 38.6% level. Yes, but we don't use that, okay? We actually model the market in a different way. All right, so, and again, we only use those four levels, so it simplifies a lot. You don't have all those Fibonacci levels, and you say, oh, which one is the right one? All right, so simplification is nice, simple is good. And so, let me show here an example in which we have from lows to the first level, 96.82 there. There's a participation of 94.30. And then the market continues higher into the first target, but it continues even higher. And you might say, okay, Giuseppe, you picked up this example for us today. No, I gave you the models. You go back home and you start measuring these on your charts, and you'll see how frequently you get these kind of signals. Now, the point is, how do we get advantage of that? That's something different. But what I wanted to show you here is that once the market gets to the second target, which is that 100 there, here it shows us, imagine web, which is from the highs, 96.82 to 100, and we get participation into that 98.41 that eventually brings price into 175, which is our target. Okay, so I just gave you two simple models you can use, and you can go back home and just apply them, and you come back to me and say, oh, they work very, very often on high volume markets. So I'm using Forex, I'm using SP500 E-mini futures, and you can use high volume stocks, NASDAQ 100 stock, SP500 stocks, SP100 stocks, and NASDAQ stock as well. All right, so if you want to get more information on this, it's all free, it's all on FXstreet.com. You just go look for FibStalker. And by the way, that's my little nickname. But I promise I only stalk price, and I'll show you how I stalk price. I don't stalk people, just stalk price. Okay? You can't. All right, so there's a lot of material there, and if you go back to 2014 webinars, which are all free, the majority of them, there's May 19 traditional and new uses of Fibonacci in modern markets, which actually goes a little bit in more detail of what I showed you. And of course, money risk management is, I talk a lot about it because it's it's fundamental actually. Now, there's not a lot of time to show this, but I mentioned before that algorithms have internalized the psychology of the market. In fact, if you apply these models on the last 150 years of the stock market, you will see this model working again, again, again. So I won't have time to show this, but if you go online, you will find the presentation and you can look at that. Now, I will only show one thing, that the traded market crash in 1987 was not only then an extension. After the market traded the 50% level in 74, the crash was captured 220 there. Sorry, it was not 220, it was 65, 62. And look at the beauty. This was the model applied there. Look at the beauty in the 74. The 74, if you trace from the highs in 72 to the highs that we had in 87, 86, 87, the 50% captured the lows in the crash of 1987. If there is not something there, you tell me what there is, okay? All right. So I think we established that there is something maybe fundamental that algorithms have modeled about the psychology of the market. All right, how do we apply this in current markets? This is a call I made in October 17th. I'll give you the link there. And basically, when the market, this is the SP500, when the market went above the highs in 2000s, and this is the futures. Mind that the futures have a different shape. If you compare the futures and the SPY or the cash, you will see that there was a higher high for the futures in 2000s. Now, this is the future conscious, the continuous future conscious. Now, look at the beauty here. If we get the 2000s high and we keep tracing as the market continued higher, right? What happens is that at some point, as we trace from that level to high, at some point the market came right into that 109, 108.9 there. And as I mentioned, we never buy these levels blindly, okay? We always look for confirmation. Let me show you how we look for that confirmation. So once the market got into the level, then it went to the first target, 2082, all right? And that's the level that traded. I gave this call a few days before. That's the YouTube. It's there for you. If you have any questions, let's wait for the end of the presentation, as it's very packed, and unfortunately we started late. Now, 1 year later, the plunge protection team does it again. And if you were ready and using these models, you would be able to capture that low, the next low that came, as you remember very well now, if you follow the market. It came in August the 24th, 25th, and then again there was a confirmation at the end of September. So, same model. We used the year of 2011, 2000, and by the way, I'm not hand-picking this example. These are rules of the code of the FibStalker methods, okay? And if you take the time to study the material that is free, you will realize that this happens all the time. So same situation there. We trace from the high of 2000 to the new high, and imagine where the market stops. The market stops in that area that starts in the 50% and never breaks the 61.8% level, all right? And not only does that, in that area, right there, and of course I made this call in advance, because I can do this kind of this thing in advance. It doesn't mean that I buy that level, but I know that the level is there. Now, if the market gives me a confirmation, then I buy. And I'm going to show you how the market can give the confirmation. It works really like this. You have a 50% level, and then you have a counter trend into that market, which is shown here in a few weeks in advance. And on the counter trend move on the smaller time frame, there is exactly the same sequences of moves that you would model on the larger price. Now, the way it works is that if we get participation at that 50% level, and clearly we got that participation here on this SP 500, and the market is strong enough to break, so to speak, the back of the bears that are actually pushing the price lower. That's the confirmation I'm looking for. Can you see that the confirmation is coming from participation? It's not coming from me deciding or an indicator deciding for me. Have you seen that I use no indicators? And there is a reason for that. So it's pure participation. If there is participation at the level, and it breaks the sequence of measured move on the short side, then I'm interested in buying that market. And again, I made this prediction, if you like to use that name, it appears that a lot of people like to use that name, on September the 14th for the secondary test as well. But on my newsletter, I mentioned, of course, the analysis all the time. And I will keep mentioning this analysis on the FXStreet Tokyo Open live room. Every day it's free. So you can join in and look at how we do the analysis for the markets. Now, the market actually moved in extension lower, so what I did there, I used the 100 to lows, and that gave me a 61%, 1964. That was my break. That was my indication that the participation coming from the daily was strong enough to break the back of the bear. So, of course, this happened again. As you can see, after the market pushed into that area, it came up, and then it went to retest the level. Look at where it starts, very, very close to the 50% level. And then again, I can show you another example of that timing, this time on the 4-hour time frame, right? On the 4-hour time frame, we had the first measured move that pushed price lower at 1946. The price went to the first target. We traced from highs to lows again. We got the 1917 confirmation for an entry, and the market continued higher. Okay, so as you can see, there is structure in the market that you can model using those two simple models. Of course, there are other models as well, but if you use those two, you will always have quite a good idea where the market can go. All right, so. The concept applied is exactly the same. There's a sequence on the way down. It tests the 50% level. If there is participation from the larger time frame on that level, then, and the market breaks the back of the shorts, which in this case are represented by that 1917 level, very, very precise, you have to get involved long. You have to, which stops below lows, because now that indication is giving you that signal that is giving you the indication that the low might be in, and you can use that low as your stop as well. I do it all the time. All right, so and here we used exactly as I mentioned before. I think I went back here. All right, so in the previous move here, we also had a sequence of measured move, counter trend sequence of measured move into that 50% level, right? And here we go. And here the counter trend sequence. From 100 to the low, I captured 1944, pushing price lower into first and second target. The market goes below the second target. I trace from the lows to lows because the market is extended. It gives me the 61% level at 1856.75. Once that is broken on the upside, it's telling me that there is participation strong enough to win the algorithms that are actually trading against that level, okay? Because algorithms trade continuously, one against the other, this class of algorithms specifically. All right, so, and again, the model is always the same. So once you know where those 50% level from the larger time frames are, you can actually analyze the sequence of measure moves on the smaller time frame, and if that breaks after the 50% level has been tested, you have a confirmation for a potential continuation in the direction of the market. Now, I won't have a lot of time if we have to stop at 12. So, because I wanted to show you another example as well. If we have time later on, I'll show you the call on the US dollar Japanese yen, a trade that brought 23 unit of risk in gains. And that was a move from 121 down to 114.80. And if I have time later on, I'll definitely do that. What I wanted to do now, I want to talk a little bit about risk because it's very, very important. And my apologies, I will need to sit because I need to operate the console. So sorry if you don't see my face, but I wanna switch. I want to switch gears here. So maybe if you want to move, sorry about that. Well, let's say if we can move this slightly. Sorry, no. All right, so, okay. So what's the FibStalker console? The FibStalker console is a piece of software I've started to actually fill a gap in my own trading, because I've been trading with TradeStation forever. And as I moved to Canada, because I now live in Canada, unfortunately, TradeStation is not regulated for Forex trading in Canada. So I had to fill that gap, right? And I had to do it for myself. And then I thought that that would be something good for other traders as well. So bear with me and tell me what you think about it. So I'm adamant about risk management, okay? When people ask why I'm not successful in trading, you don't manage risk. Case closed. There's nothing else to ask. Okay, so in my trading, I've always managed and pushed to try to identify as many risk parachutes I can, and I strongly believe that the markets can do anything. So anyone who comes with you with an assumption and say, you know, I believe market will do this, will do that. You can believe whatever you want. The market will do whatever he has to do. So to me, risk containment and risk management is trader's job number one. Now, you'd say, how can we do that? And obviously, you know, first thing is fixed fraction risk, less than 1% of the account. That's what I risk. And if you believe that this is commonly understood, let me tell you that in 2014 I was talking to the American, to a representative of Oanda, and they presented me with aggregated data showing that 22% of their clients, they get margin calls, which means that they don't even know about risk management. They don't know about managing risk. Now, of course, add stops, because if you have stops, you will never oblige, you will never use them. Trading in low risk areas, and I mentioned here the bandwagon theory. I won't have time to get into that, but again, search on FXStreet and you'll find very good information there. Adopt a free risk approach. When I speak about this to people, they say, why should I do that? Now, what's a free risk approach? It's very simple. You take a position, and once the gains equal your risk, you exit half of your position. If you do that, what happens? The magic happens. And what happens is that if the market comes back to your entry point, to your stop, you're stopped out at break-even plus cost of trading. So your costs are only the cost of trading. Very, very important. And I don't understand why people do not adopt this simple, straight, simple mechanism in their trading. So wait for testing for error participation. As I mentioned before, you have to wait for the 50% level to be tested. You don't want to do anything before. You have to wait for those level of participation to be tested, because it means that there is participation from that time frame. And of course, wait for confirmation, which on the other hand is to make sure the price gets above those red lines, all right? And make sure that there is enough room available to price. Of course, you have to accept risk. Now, trading is a process of elimination, so you have to do proper price analysis and price discovery to filter out low probability opportunities. Proper money management, just forget things like intuitive sizing, I know more or less how much I have to trade, JORAs, Kelly criterion, optimal F, risk based on winning percentage, just forget about them. They do not reflect the multiple distribution of your trading system. Just forget about them. It's very, very risky to trade with those kind of things. And you are gambling, by the way. So there are other aspects, but most importantly, or as important as the other risk managers we have, is proper execution. At this point, I want to make a quick demo of this little guy I have here. I created a simple natural language-based interface for trading with automated volume calculation based on fixed percentage of risk, which is calculated for you based on your account. Automated order insertion and execution, of course, because we want that. Automated risk-free management, very, very important, right? Because we want that to be included in our trading. And then there are a number of other bunch of things there. So let me see if we are lucky enough and we can run this. This is ALGO, which is part of the CTrader suite. This is free, and the reason why I have to go from TradeStation to this, unfortunately, is because again in Canada I cannot use TradeStation for forex. All right, so the console, it's really a simple. It's really a simple application here that runs as a C-bot, as a robot within CTrader. And the beauty of it is that I can do simple things. I don't know if you can see that, but the console is welcoming me, saying, welcome back, FibStalker. But besides that, what is important is to look at the commands that we can insert here. So we have simple things like, of course, entering an order, modifying an order, closing it, canceling it, and using and setting parameters. So without no further ado, let's do something like this. Let's buy the euro-dollar now at market with a stop maybe, let's say below, I'm just looking at price now. Let's put a stop. Of course, I'm not willing to, I'm not demonstrating profitable trading here. I'm just demonstrating the console, okay? For the profitable trading, you can come on FXStreet every day, Sunday to Thursday, 8 to 9 EST. So we have a low here, 110.03. And so what we can do, 110.03, right? And of course, that's what you don't want to get, right? During a demo. So let me, of course, this is a beta, okay? This is a beta version here, and so that's exactly something that should not happen when you're doing a presentation. But let's be decisive about it. So obviously here, okay, so now the system inserts for me. Can you see? I mean, I used simple natural language. I said buy euro-dollar now at market with a stop below that level. And fortunately, we don't have a lot of time, but the idea here is that the market, the system is actually inserting for you the order, as you can see, with the stop loss. There is the free screen level there that it's done for you. automatically, and the beauty of this is that it manages risk for you. So it's 1% of your capital. You insert the trade, you just forget about it. If it gets to the freeze trade, half of the trade is out, and you just define and bring your position to the profit level. Now, each of these is going to represent a position, and you can have up to 12 positions opened in the system. And what happens is that you can then manage this position. For example, you can actually modify the profit level. You can close the position. But there is something more interesting, and there's a lot, of course. There's no time to demonstrate that. But one thing I would like to demonstrate, and I know the time is up, but I will just demonstrate this. So there is the possibility to set some parameters. For example, I can set stop loss, and I can give a level, and then I can use that level within an order as well. So for those of you who like to study the market and set levels on the chart, this is and that's what I do, because I mentioned and I showed you how I look at price, right? So for me, levels are very, very important. And so what we can do, we can actually define some levels. For example, I could define low here, the 110.66, and then 110.66, and then use that, have it on my platform, and as you can see, it's being showed on your platform now, and then use that within a command to basically use that level that I identified before in my analysis. So what is my okay, so there was not a lot of time, and unfortunately we had to start later because of the technical problems. But the idea is that we can manage some of the risk parachutes without even thinking about them. So the only thing that you have to do, you have to identify the levels, and you have to identify the sequence of measure, move, counter trend, and when you have that confirmation, you can enter the trade with a stop, and the platform is going to handle the risk management for you. So I will need to conclude here, and that's unfortunate because I had some other information to share, but I hope that the presentation was interesting. The algorithms are real. There are families and groups of algorithms real on the market, and there are ways to take advantage of it. Okay. Thanks a lot for being here.